Welcome to FT Markets. With commodity prices from oil to iron ore falling sharply in recent months, what is the outlook for the mining sector and some of the biggest companies in it? With me to discuss this topic this morning and to cover some other issues ahead of LME Week is Catherine Raw, Portfolio Manager from BlackRock Natural Resources and one of the world's biggest mining investors. So in recent weeks, Catherine, we've seen the IMF and other leading forecasters downgrade their forecast for global growth. Obviously, that's going to have a knock-on effect for commodities. How worried should investors be?
Well, I think actually commodities have already taken that into account. So one of the reasons that we've seen commodity prices fall over the last few weeks, months, really since around July, August, we've seen quite a pullback in commodities, has been because of the slowing growth rates. So because we've seen demand rates not accelerate at the rate we thought. And then in the case of iron ore, for example, that you referenced, we've had quite a surge in supply at the same time. So actually from here going forward, I feel that the commodity prices are probably taking that into account, and it's actually more the supply side factors that we now need to consider when you look at what commodities are likely to do well versus those that do badly over, say, the next 18, 24 months.
Okay, so there is a chance then for investors to look at those fundamentals, the supply and demand ones, and actually pick out which commodities they think will do well. And there's still a possibility that some of them, despite this unfavourable macro backdrop, could actually do quite well.
Absolutely, and it's very specific. So zinc's a good example of a commodity where you've had supply side growth fall to very low levels, and people are predicting actually potentially it could fall over the next couple of years. And yet demand growth continues. It's a later stage in the economic cycle commodity. So galvanized steel to prevent steel from rusting tends to be something economies focus on when they're worried about sort of value. And so, for example, China's economy moving to later stage cycle when they're more focused on efficiency and productivity, something like zinc would benefit. So while clearly in the short term macro headwinds are probably going to weigh on commodity prices, it doesn't necessarily mean they go down further. And so what you then look at is what are those commodities that have those unique supply demand sort of drivers that makes them outperform that sort of market.
Okay, so zinc would be one, nickel possibly another one,
yeah,
just to look for those commodities.
Well, nickel's interesting because it very much depends what the Indonesian government chooses to do, but that's exactly one where you've had severe supply side shortages this year because of a single event, which was Indonesia banning the exports of nickel ore.
Okay, if we just move on for a minute and we'll just look at a chart now of the FT all-share mining index, and so the sector came back into favour, I guess, sort of around about the middle part of the year, and a big factor driving that was the expectation that management would start to return cash to shareholders or increase dividends after this big cost-cutting austerity drive that they've been on. But how worried do you think, given where, I don't know, say thermal coal has gone or iron ore has gone, will management actually be able to follow through and deliver on these promises to shareholders? Should they be expecting returns next year?
It very much depends on the company. So when you talk about that trend, I would focus on the major mining companies specifically. And so really for those companies, it's about what are the companies that are offsetting commodity price declines, iron ore price decline, with production growth and reduction in capital spend. And actually, when you look at the majors, if you look at Rio, if you look at BHP Billiton, if you look at Glencore, particularly for Rio and BHP, the level of capital expenditure this year and next is significantly lower than where they were a couple of years ago. In addition, they're growing production. So you have a double whammy of increasing volumes. So yes, the price is lower, but net you're offsetting a lower price with higher volumes. And then you're also reducing the amount you're spending. And so the free cash flow available to shareholders is higher this year and next than it has been over the last 2 years, even with commodity prices where they are today. So the debate now is how much could they return rather than whether they could return. And Rio has been really quite clear in its messaging over recent weeks that even with an iron ore price 40% lower than the beginning of the year, they still have the balance sheet flexibility, the free cash flow generation to reward shareholders going into 2015.
Okay, and just before we finish, I'd just like to talk about gold. BlackRock is obviously a big investor in the sector and gold companies. The price recently has sort of rallied a bit after we've had some comments from the Fed casting doubts on some of the growth forecasts for Europe. How do you see gold for the rest of the year? Do you think it struggles to make further progress from around the 12.20 an ounce level, or could it come back? How do you see things?
Well, I think gold is range bound at the moment, and what we've seen over the course of the year is it's trading between sort of 1,200 and 1,350, and depending upon people's bearishness or bullishness on interest rate rises, on the strength of the US dollar, and then also these outside events, geopolitical events that no one can predict, we've seen it fluctuate. As of today, when you look at futures market positioning, you look at the fact that we're moving into a seasonally stronger period for gold, driven by the gifting season of Christmas and then Chinese New Year. We would say moving into the end of the year, there is some positive momentum behind it. We've gone from 1,200 to now being 1,230. And so it's really about how strong is that gifting season. What is the Fed sort of indications of interest rate rises? Are they going to be pushed out even further? Those will be the factors that could be positive for gold going into the end of the year. And given the very bad news we've had over, say, the last couple of months, the strong US dollar, actually I would feel that there's more upside than there is downside at this point moving into the end of the year.
Catherine, thank you very much. So, with LME week almost upon us, it seems there are reasons for positivity in the commodity sector. Some metals could outperform, where the fundamentals of supply and demand are still quite interesting. And also, it seems as if the mining sector could return capital to shareholders as they continue to cut capex and also ramp up production.